Morning, everybody. Welcome to India, as Richard said. Look, we've brought you here because it is our biggest emerging market, but frankly, it's just always a really, really exciting place to come to see the power of Unilever, and it's a great pleasure to welcome you all here. 2018 has been a year of continued progress and transformation for the company, and we're pleased to talk more about that today and tomorrow with you. We want to show you, frankly, how the strategy of the company is delivering consistent performance and how that's translating into value for the company. As you saw yesterday, and as Richard mentioned, we signed an agreement yesterday to acquire the health foods drinks portfolio of GSK. That's principally in India, also in Bangladesh, but also in about 20 other predominantly Asian markets. And as Richard said, Nitin and I are going to cover that later this afternoon when we go through the food and refreshment session. Let me click over the safe harbor statement as usual and get into the key themes that we'll cover over the next couple of days. As I said, we really want to explain how Unilever is progressing on its growth journey. The first thing, and Alan just mentioned it, purpose-led and future fit. Now, this is the next stage in our journey. It ensures that the concept of purpose is very deeply embedded throughout the organization, in our people, and in particular in all of our brands. With Connected for Growth, we continue to make significant changes to our organization to operate more successfully and deliver consistent growth in what is, at the end of the day, a very ever-changing world. Our three divisional presidents are going to show you how we do this through each of the distinct divisional strategies that we have, and they're going to complement that with some specific examples from our Indian leadership. The second theme is emerging markets. The emerging markets are quite simply a massive opportunity for growth in this sector, and Unilever is extremely well positioned to take advantage of this. Now, my colleague Sanjeev Mehta, who's the CEO of Hindustan Unilever and also the president of our South Asian business and region, is going to introduce you to this important part of the emerging market opportunity. And then we'll have a fantastic opportunity to get out there and visit consumers and customers later this afternoon. And tomorrow, we're going to hear more about three key countries within our South Asia region. India, of course, Pakistan, and Bangladesh, and we're going to hear that from the leadership of those important businesses. And finally, digital. Now, while digital is very much a part of making Unilever future fit, it is easily important enough to devote a deep dive to it. And tomorrow, Peter Terkulva and key members of the team who are leading Unilever's digital transformation are going to take us through it. Now, some of you might remember Peter from the Capital Markets Day tour to the emerging markets last time we went there, which was in the Philippines 3 years ago. So it's nice to reintroduce with Peter in a slightly shifted role. And to get us started then, let me first recap on where Unilever is as we approach the end of 2018. Now, you'll recognize this chart, I hope, but we think it's really important to keep emphasizing the strengths of Unilever because scale really matters in this fragmenting world. First, we have a strong portfolio of purpose-led brands, both global brands and iconic local jewels. Across 85% of the turnover of Unilever, we hold either the number one or the number two position in the country category cells in which we operate. Secondly, we have unparalleled global reach. We're present, as you know, in 190 countries, and close to 60% of our turnover is in the key emerging markets. Third, our distribution is multi-channel, and it's extremely deep and broad. 2.5 billion consumers touch one of our products every day, a network of 30 million sales outlets around the globe. Nowhere is this strength more evident than here in India, where we have 2.5 million sales outlets that we service directly and many more beyond that. And finally, we have what we think is the most international talent bench in the entire industry. This delivers diversity in our global teams, and it delivers deep, deep experience in the local markets. 80% of the country leadership in our emerging markets are local talent. And we're the #1 FMCG employer in 44 of the 52 where we can measure that reliably. Frankly, we have access to the very, very best talent. Now, as Richard said, we're midway through our 2020 program and we're making good progress. We've created a much simpler and faster organization. All of the country category business teams, and you're going to hear this term a fair bit over the next couple of days, the country category business teams, or CCBTs as we call them, are all established and up and running. The foods and refreshment division integration has been completed, and there's more restructuring investment to come that will deliver attractive returns for the company. We're making accelerated margin progress. We're on track, in fact, slightly ahead in delivering the 6 billion euros of savings through 2019 from the stepped-up savings programs that we have, and therefore we're on track for our 2020 margin goal, and that's despite higher commodity cost inflation and some quite significant currency devaluation pressures. We're accelerating our portfolio evolution. The pace of portfolio change has increased with 28 new brands launched and 25 acquisitions made in the past 3 years, and as I said, Horlicks, which is the 26th, just announced yesterday. The sale of Spreads closed in July, and the proceeds have been returned to our shareholders. And we also have a simpler capital structure. Now, as you know, we decided not to proceed with the vote on the board's proposals to simplify the capital structure of Unilever, but we did have very extensive engagement with shareholders, and frankly, we received very widespread support for the strategic principles behind unifying the parent company structure of Unilever, even if we didn't get support from all constituencies for the particular route that we're proposing to achieve that. And of course, we're still significantly improving the governance of Unilever by cancelling the NV preference shares and removing the associated disproportionate voting block that those preference shares held. And finally, we've increased our leverage and we've stepped up returns to shareholders with the 6 billion share buyback completed and our net debt to EBITDA ratio at 2 times. And of course, we'll continue with strong dividends. I'd like now to take another look together at the growth algorithm of Unilever. We see a multi-year range of underlying sales growth between 3 and 5%, and this comes from outperforming our markets, where growth is currently sitting at around 3%. This year, we're closer to the bottom end of that range, and whilst we haven't been perfect, there are a lot of things we have done right, and so we're relatively happy with where we sit right now, albeit excited about the future growth opportunities that are available to us. The world is a very dynamic place, and our growth is competitive. Asia is doing well, in particular here in India. All of our recent acquisitions, with the notable exception of the Blue Air purification business, are growing in double digits, and our new brands are starting to add further to our growth momentum. There have been some speed bumps along the way. Through an economic lens, we've experienced severe slowdowns in key geographies like Latin America and an extended period of relatively benign commodity inflation, although price has started to pick up as we expected in the second half. Through a business operations lens, we've seen disappointing performance from Blue Air and competitive tensions in North America that have increased promotional costs and impacted growth there a little bit. But in terms of the fundamentals, we're managing well and changing our business in the right way, positioning Unilever better to capture the growth that we know is out there in our markets. Let's get into some more detail about the key themes and how Unilever will grow. We've just had our annual Change Leaders Conference, where we introduced and started to cascade our belief and vision of a Unilever that is both purpose-led and future-fit. And this means simply that we will strive to be a truly purpose-driven business, serving people to help them live more sustainable lives. We believe this is the only way for us to create long-term financial success and create positive impact. Under purpose-led, we have 3 important areas that reflect our most important assets: our brands, our people, and the company that is the glue that connects them together. Brands with purpose grow. We will use our brands to improve the health of the planet and contribute to a fairer, more socially inclusive world. We've demonstrated over the last few years that brands with purpose grow 50% faster than those without. And so we are ensuring that all our brands now have a purpose throughout our organization. People with purpose thrive. In 2007, we launched a program to support all of our people in discovering their purpose and translate that into their personal development plans. 20,000 people have been through this program, and we've seen very strong positive impact on our ways of working. For example, 81% of the US CCBT teams reported an increase in collaboration following the program. And in Vietnam, where 92% of our employees have been through the program, our employee engagement sits at a record 81%. And finally, companies with purpose last. For many years, and indeed since its very formation, Unilever has a strong vision and purpose around making sustainable living commonplace in the communities that we serve. Now, this shows itself in many areas like plastic reduction, carbon reduction, and the incorporation of the Unilever Sustainable Living Plan into everything that we do. The USLP has helped us to come this far and will ensure that Unilever thrives long into the future. And on the subject of future fit, there are several highlights. Firstly, we're digitizing our business. Now, it's important to understand that this isn't just about digitizing our media investment and our marketing tools, but it's about digitizing all of the aspects of Unilever's business so that we can leverage the world of data and increase our digital capability in everything that we do. As I said, this is a whole theme in itself that Peter will cover with us tomorrow. We continue to make significant portfolio shifts towards high-growth areas such as naturals, e-commerce, premium products, and emerging channels. We continue to reshape the cost and asset base of Unilever, taking out non-value-added costs and complexity through our key programs. That's 5S, ZBB, and Net Revenue Management, or NRM, together, of course, with our restructuring investment program. And finally, we're unleashing the full potential of our C4G organization by ensuring that all of our CCBTs are provided with the analytical tools and the capability to work as effectively as possible in finding those insights that drive growth. And the result of all of this is a Unilever that is faster, that is more agile, and that is closer to the consumer. We have 3 strong divisional strategies. As you know, we're now organized in 3 divisions, and each of them has a very clear vision and a distinct strategy for how they go after growth and balance the delivery of growth and margin in a healthy way. Each division has increasingly distinctive requirements in terms of innovation, consumer engagement, and market capabilities, amongst other things. They need to be able to compete very effectively against a focused competitor set. BPC has a role to deliver global innovations with local relevance by moving to more premium positions and expanding in the high-growth segments. Margin expansion in BPC will be delivered through innovation, through improved product mix, and through growth leverage. Sustained gross margin improvement will be reinvested in BPC to drive faster competitive growth. Home Care will build on its already strong emerging market footprint with a strategy of market development and benefit-led innovation for emerging needs. At the same time, Home Care will continue to move towards a sector benchmark margin using the key savings levers available to it, principally our 5S and ZBB programs. Food and Refreshment, as I said, is now combined into a single division, and that results in a leaner business model. F&R is focused on accelerating growth by building out the portfolio in emerging markets, hence the Horlicks transaction, and purpose-led brands, and stepping up underlying operating margin through our savings and value programs. But our divisions live in our markets. The strategies live directly there through the CCBTs, who are at once both more global and more local, and always empowered in our business to make the key calls on the ground closer to the consumer. The CCBTs execute the strategy for each division, comprising both global innovation and local innovation. This division-first structure in the country is effective because it ensures that we don't make irrational decisions that might trade off the divisional strategies within each country and that are driven also, and are driven also to deliver both global innovation at speed and deliver locally led innovations that reflect faster global trends. So the divisions are in the markets. We run dynamic resource allocation within the year within each division. And this enables the three divisions to move investment between countries, optimizing to back the winners and ensuring we can be very responsive to emerging trends and emerging challenges. We also have many programs in place that make us more agile and responsive. The examples here are Lean Like a Startup, which is a program running within our innovation teams that helps us to launch products faster with a lower financial commitment up front and a clear emphasis on iteration. Another example shown here is our U Studios. That's our in-house and now our biggest digital agency, which are now across 14 countries with 4 more to follow very soon. These specialize in the creation of relevant content for social and digital advertising. Through the U Studios, we can deliver high-quality digital work in less time at an average cost saving of 30%. Let me turn now to how our portfolio is changing. We're adapting our portfolio because the world is changing. Consumer preference is becoming more natural and more convenience-led. In some sectors, there's an erosion of trust in big brands. And of course, as you know, the consumer path to purchase is no longer linear. Fragmentation across consumers, channels, media, and competitors means that we need to be more agile than ever, and our portfolio needs to change quickly to keep up with the demands that fragmentation creates. We've talked before about the bee swarm of new competition, and in beauty and personal care alone, there has been 6,000 brand, and I mean brand here, not SKUs, 6,000 brand launches in 6 countries in 2 years. And a third of those have been through direct-to-consumer channels. Now, most of these brands have not been successful, but our job is to manage our business well through this level of fragmentation and change. Unilever has been a company in constant evolution, always seeking to move towards the future trends where there is higher growth. Today, as I said, we have 85% of our business in leading positions with market leadership in some fantastic scale businesses such as US hair, Brazil deos, India laundry, and UK ice cream. And since 2001, we've significantly shifted our footprint to become close to 60% emerging markets, with some 40% of our turnover in beauty and personal care. In fact, in BPC, over that time period, we've added turnover that is equivalent to the size of Estée Lauder today. In recent years, we've stepped up the pace of our portfolio evolution through M&A with 25 bolt-on acquisitions, which we're looking to scale quickly. Whilst this year has been a little bit lighter than last in terms of sheer transaction numbers, we certainly haven't let up, and we continue to experience a lot of activity within our M&A funnel. Through these transactions, we've acquired 2.5 billion euros of turnover and disposed of 4 billion euros, much of that through the exit from spreads. We've built a 500 million euro prestige beauty business, and 1 billion euros of the acquired turnover has been in the high-growth space of naturals. Alan's going to talk about how our acquisitions in BPC are progressing, but I want to pick up just a few highlights because in aggregate, we're pleased with the performance. In BPC overall, the acquisitions are adding more than 60 basis points of growth. Our prestige business, now $500 million, is growing at around 9%. Dollar Shave Club continues with strong growth of around 10% in the US. Seventh Generation is growing at around 7% and is now building its presence in the UK. I could go on. We've also been very busy launching new brands with 28 launches in the last 2 years. 21 of them are set out on the chart here. This compares to just 3 launches in the entire previous decade, so a very significant change in Unilever. Love Beauty and Planet is our biggest new brand success to date, and there are many others that have started well in individual countries, so are likely to be scaled at some stage. Examples are Growing Roots, Prepco, and Keiju, for example. Of course, some of these brands will likely fail or need to be iterated several times, but this is a startup mentality, and we're happy to take risks and experience failure where we learn from it. The stepped-up launch activity does increase the complexity of our business, but to counter this, we are operating in a fundamentally different way. We're leveraging third parties and our existing R&D partners to launch these new and typically high gross margin brands fast without upfront CapEx investment. This allows us the flexibility to experiment, to learn, and to iterate. It's relatively low risk, high return, and above all, fast way of innovating, and quite a departure from the traditional market entry model, which requires heavy investment upfront for a brand that might indeed ultimately fail to create a viable share base in a new market. Today's consumers are demanding of new, trend-led products, and we must respond to that opportunity to be successful and to grow. And we continue to build on our distribution strengths as our footprint evolves with our consumers. It's important that we are always present in the right channels to win. This doesn't mean only in e-commerce, since as shown here, a large proportion of our consumers are going to continue to shop in the hyper and super channels. And while shoppers do appreciate convenience more and buy more in the moment, supermarkets will still be our largest channel for many years to come. Discounters and convenience are areas of strong channel growth, and this has implications for innovation, for range, for product design, etc. And we'll address these through our program of net revenue management. In fact, in discounters, we've been successful in improving the overall channel margin through more effective core SKU targeting, through a focus on promotional deal margins, and by working the customer mix. Very importantly for Unilever, and as you'll see later today when we head out to the market, we continue to see very strong growth of the traditional trade channels in emerging markets. We're putting a lot of focus in our emerging market channels to ensure that we are increasing our traditional trade insights, capability, and reach, in particular, leveraging data and digital in this important channel. And marginal growth is really important, of course. And over the next 5 years, we expect around 30% of our turnover to come from a combination of experience platforms and from e-commerce. And that means effectively a doubling from the 15% of the business that it was in 2012. Of course, channel shift brings a bit of disruption, but we see many, many opportunities in the more rapid growth channels. For example, health and beauty, which is an opportunity to drive for product education and greater trial. Our own brand stores give us direct access to consumers and the opportunity to build brand equity by experience rather than media. And e-commerce gives us new distribution points, allowing greater targeting and, of course, data-driven marketing. To fund this channel and capability shift and drive our growth agenda, we need resources. And to deliver that, we have a fully comprehensive suite of efficiency programs available to us, with still more to go for. We're continuing the journey of creating the fuel for growth, providing the resources needed to make our core and our new brands and our acquisitions successful. Let me start with ZBB. Our ZBB program is very well embedded now in the business. It's been running since 2015, and it's set to continue at least until 2020 and possibly beyond. And we recently sat down and had a multi-year review with our partner, Accenture, and they revealed some stats to us, which I think, with all humility, we can feel good about these. We have carried out ZBB this is from Accenture. We've carried out ZBB on an unprecedented scale in terms of the cost base that we've identified and the global reach of the program. We went from a pilot in Thailand in 2015 to a full cost program across the corporate center, all of our divisions, and across the top 20 markets. We're the first company in their experience to set a target of 1.6 billion euros for the first 2 years, and we over-delivered on that. We've reinvested 50% in media, and we've seen absolutely no impact to brand health, which, as you would expect, we tested in great detail as we rolled out the ZBB program. In fact, the majority of our sales increased their media spending using the fuel generated from the ZBB savings. In aggregate last year, we increased the amount of consumer-facing media and in-store activation investment by around 250 million euros, while we reduced our advertising production spend by 170 million euros and banked a further 70 million euros of efficiencies by improving the return on investment on our brand promotions. And you can see from the quartiles on the chart that we've had savings in several different areas. In brand and marketing investment, we've moved to be top of the third quartile for absolute savings as a percentage of turnover, with most of the savings, as I said, coming from advertising creation. So we're creating fewer adverts, using less agencies, but showing them to more people for longer. In facilities and in travel, we're nudging towards the first quartile in terms of savings, but this has always been an area that we wanted to prioritize. Frankly, less time on planes means more time in front of consumers and customers, or indeed with families. In 2017, we reduced travel costs by a further 14%. Now, to be clear, we don't always want to be top of these quartiles. So, for example, in BMI, because we're a brand-led company and because our brands require support, but we do use these benchmarks very actively as an effective way to judge our progress. Moving on now to 5S. That's a program which was pioneered in home care. And 5S isn't just about savings. It's a very holistic program. It's about pricing, it's about mix, it's about buying, partnering, and sourcing. It's about how we design our products and what the core product platform needs to be. The first element is pricing, which, as I said, picked up in the second half of 2018. The main aim of pricing in consumer goods is to cover cost inflation, and costs were pretty benign in the first half of 2018, and that's why, frankly, you saw little pricing. But Unilever is usually first out of the blocks when it comes to recovering input cost inflation, as you saw from our Q3 results. And it's also why, over the last 10 years, we've had pretty balanced price and volume growth in the aggregate. From a buying and a product design perspective, we combine the 5S program with structured initiatives like Design to Value, which we began in 2018 with 60 market workshops. That helps us to understand the specific attributes of our products that are most important for the consumer, and to distinguish these from those attributes which are perhaps less relevant. In total, we're targeting 4 billion euros of savings between 2017 and 2019 from the supply chain. And 5S is a very important part of delivering this. We're pretty much halfway there in terms of delivering the savings, and around 2/3 of those savings are being reinvested behind competitive growth. Moving finally to net revenue management, this is about having the right product in the right place at the right time. The program has also been running since 2015, and 65% of the sales in Unilever are reporting growth in net revenue realization. That's, for example, turnover per ton or turnover per wash, driven through list price changes, pack price architecture, and mix. One of the best examples I can give you of NRM is in our US Deos business, where we've been becoming more premium through changes to format and benefit platforms, and through getting the in-store incentives right. The result was that we could drive pricing, address cost headwinds, and continue to grow both volume and share. Now, 65% of sales growing net revenue realization is a little bit behind where we'd like it to be, but we're clear that by focusing on additional opportunities in both consumer price promotions and in trade terms, we have plenty of scope to improve this further. We also estimated 3.5 billion euros of restructuring to make the changes fundamentally that Unilever needs to compete and win. This program will have full impact by 2019, as most of the projects are relatively complex and so take a little while to get going. As a result of these programs, we can feel good about delivering both growth and margin. So whilst we have some commodity and currency pressures at the moment, and things may move around a little bit by division, of course, as the commodity mix hits in a different mix in different places, we feel confident about hitting the 2020 margin goal. Having said that, I do want to state clearly again, as I always do on the subject of that if there's ever a choice to be made between growth and margin, will always be inclined to go for the growth. Now, we've come to India because it's a key emerging market. There's rapid growth forecast in the D&E world, both from population growth and shifts in living standards. The IMF estimates that there will be another 300 million people, that's another USA, living in emerging markets by 2021. In contrast, there'll be hardly any population growth at all in the developed markets. In addition to that simple population growth, 800 million more consumers will live in cities with more kitchens and more bathrooms available to be cleaned. 400 million more households will reach the all-important middle income bracket, driving up per capita consumption of products just like ours. And 200 more women will enter the workforce. There has therefore never been a bigger opportunity for Unilever to grow and to develop the market quite disproportionately compared to almost all of our peer group. Now, this chart was inspired by a presentation given to the ULE by Professor Ian Golden of Oxford University, EBRD, and I think he was at the World Bank. And it was focused around relative birth rates and immigration rates. And he claimed in his presentation to be quite simply stunned by the huge opportunity in our footprint. And I think he's right. Looking at the chart, you can see GDP growth in emerging markets continues to be 2 to 3 times that of the big developed economies, even though in some places there's a natural slower pace of growth versus the last 10 years. It is expected that Asia will contribute 80% to the 1.7 billion people who will enter the middle class in the next 10 years. So, ladies and gentlemen, emerging markets have been and will continue to be fundamental to Unilever's growth. 85% of the world's population already lives in these markets, and the number will only go up. And when we think about the opportunity for growth in our categories, you see the emerging markets' growth potential dwarfs that of developed markets. This chart turns that relative growth rate on the previous chart into the absolute opportunity in Unilever's categories. We put this together using both Euromonitor and Oxford Economics GDP forecasts. It's without inflation, and so in our view, it represents pretty fairly the opportunity that Unilever is well placed to capitalize on. Just a word about some of these countries. In China, we have 15 factories, 7 sales offices, and 90% of our managers are locally recruited and trained. We're India's largest fast-moving consumer goods company. We have a heritage here of over 80 years, and 9 out of 10 Indian households use our products every single day. In Indonesia, we're the #1 employer of choice, not just in consumer goods, but across all sectors, with a 6,000-strong workforce and 9 factories. In Pakistan, which you get a chance to see tomorrow, we're investing $120 million over the next 2 years to enhance our manufacturing operations across our 4 factories to service the growth that we see. And Brazil is our 3rd biggest business worldwide, where, of course, we hold the #1 share position. Let's look in a little more detail in at Unilever in those important emerging markets. They really are our growth engine. And today, already 58% of our sales and a little bit more of our underlying operating profit comes from the emerging markets, and that gives us a natural tailwind when consumers are doing well. Over the last 25 years, emerging markets delivered for Unilever, on average, 9% underlying sales growth, with a little more than half of that coming from volume growth. And that's the same over 10 years. And whilst the last few years have seen us a little bit below this trend, we are starting to see encouraging signs of a pickup again. If we aim off for the strategic investment markets of China and Russia, our emerging markets are accretive to our profitability. So as they grow, we'll see mixed benefits. And we have very broad portfolio exposure to those emerging markets. And that reduces the overall inherent risk of the volatility that exists in these markets individually. We're also investing for growth in our Tier 2 emerging markets, which already represent 20% of Unilever's turnover and 30% of our growth. This group of countries in the middle there includes Pakistan and Bangladesh, which we'll learn more about tomorrow. And we're continuing to increase our distribution even in the biggest Tier 1 emerging markets that we have. For example, here in India, our coverage and assortment has increased by 80% compared to 2015. In China, e-commerce is now close to 20% of our turnover, and in Indonesia, we've expanded our reach to the outer islands of the archipelago. We develop markets. Market development happens in Unilever in 3 ways. First, as consumers become more affluent, they look for more benefits in the products that they're using. And these benefits can often be convenience-driven, such as moving from a soap-based laundry bar to a detergent powder, and then to liquids, and then on to monodose capsules. Secondly, we can move consumers across subcategories within a brand, as we have done with our biggest brand, Dove, moving from bar soap to shower gel to deodorant to shampoo, and then on to skincare. And thirdly, we use market development, of course, to build multi-category businesses, the Unilever of the future, in new geographies. Typically, we start in laundry and bar soaps. We then extend that to tea, to hair products and food, and then finally, as the market and logistics infrastructure have developed, onto ice cream and deodorants. And it's this last form of market development where Unilever really stands apart from its peers, because our category portfolio, the broad portfolio of categories, and our global presence allows us to be constantly expanding what we do in each country as they go through the development phases. But to win in this future world, we need a very different set of capabilities that puts the consumer first in all of our innovation and growth plans. And this is where digital skill is vital. Peter's going to take us through this tomorrow, but I wanted to tee that up with a few key highlights now. Technology is everywhere. It changes the way we work, shop, and live. Consumers want products that are tailored to them, and they want it now. This applies to everything: groceries, takeaways, entertainment, and transportation. People look for experiences from the products that they buy. They want to try something new, whether it's ordering through Alexa, or a top-up on Persil, or having an online skin consultation. And this results in opportunities for those who are agile enough to take them. Now, Halo Top did a really great job of this in building a share position in US ice cream with our high-protein offering. And 7th Generation were doing exactly that in natural home care and continue to do that now that they're part of the Unilever family. But opportunities are not just for the small players. As expectations and channels change, we see a huge opportunity to better understand and connect with our consumers. And we can do this through the massive amount of data that's being generated. Whether it's consumer profiles, social listening data, data from suppliers, factory operations, or financial data, we need to harness the data to deliver unique insights and ways of working right across our business. By getting the right insights about our consumers, we can be sure that when we talk to them, they will listen and they will respond. And that's why we truly are digitizing the whole business of Unilever. We're powering it with data at scale. Technology and data analytics must sit at the very core of our business, whether we work in talent and organization, whether we work in marketing and finance, or in operations. And to do this, our Enterprise Technology Services, or ETS group, work closely with partners like Microsoft, Salesforce, SAP, and Adobe to create a world-class infrastructure that our CIO, Jane Moran, will talk to tomorrow. And the information and analytics team, led by Andy Hill, who you'll also see tomorrow, within ETS, they're the force behind building out the data analytics tools to drive our decision-making in all of the areas that you see here on the chart. Now, while there's still a lot to do on digitization, and it's a constant journey, we've already made a lot of progress. We've almost achieved our initial milepost of securing 1 billion consumer connections, and we've leveraged this through more than 70 communication campaigns, resulting in a clear step up in the performance of those campaigns. In fact, in one of the Dove campaigns, we had a 60% increase in the click-through rate, and in Ben & Jerry's, we had 67% increased conversion. So we have many examples of where this is making a real impact. In sales, our e-commerce channel continues to grow fast at around 53%, and we're driving the digitization of our general trade model through programs such as B2B, where we have a B2B app right here in India that you'll hear about and see in action tomorrow. In our operations, we've automated over 250 processes to date, helping us to increase speed and reduce cost. This has already saved us over 120,000 hours, and we're increasingly leveraging robotic process automation to optimize our consumer-facing and back-of-house activities. But for all of this, our people have to be digitally savvy, and we need an entirely digital culture. Our CHRO, Lena Nair, is going to share more on this, but suffice to say, we are both upskilling our existing talent and recruiting new digital talent to Unilever. So in summary, this is one of the most exciting periods in Unilever's history, and we have a huge opportunity ahead of us as we digitize this company. Just like to end on value creation and our value creation model. It's a model of superior long-term value creation, delivering on both growth and on margin. It comes from a purpose-led and future-fit organization that is underpinned by the USLP. We have a multi-stakeholder approach that puts the consumer first. Thereafter, our customers, our suppliers, the planet, our employees, and the societies in which we operate. And in this way, our shareholders benefit more for longer. And that really is Unilever in a nutshell. We'll always put the consumer first, because by maximizing what we do for our consumers and the partners that sell our products, we will simply deliver more value for longer. I'm going to finish there. I've got 3 or 4 minutes left. I don't know if anybody would like to ask. I'll maybe take a couple of questions if you've got any, and otherwise I'm going to hand off to Sanjeev.